Warren Buffett is a paradox. He lives in the same modest house he bought in 1958 for $31,000. He drinks cherry Coke. He reads the newspaper. To the world, he is the kindly grandfather of American capitalism. But here is what they don't tell you. Behind that grandfatherly smile lies a machine, ruthless, efficient, the most sophisticated capital allocation engine ever constructed in modern finance. A trillion-dollar empire built not on leverage, but on a systematic exploitation of compounding returns. Most investors look at his stocks. The elite look at his architecture. While the S&P 500 returned roughly 10% annually over the past 6 decades, Berkshire Hathaway delivered nearly double, 19.8%. That doesn't sound revolutionary until you understand the math. $1 million invested in the S&P in 1965 would be worth approximately $300 million today. That same million in Berkshire? Over $40 billion. This is the story of how Warren Buffett built the greatest compounding machine in financial history, and why understanding his architecture matters more than ever. Let's start with the irony. Berkshire Hathaway, the world's most successful conglomerate, began as a failure, Buffett's worst investment. In 1962, it was a struggling New England textile manufacturer. This wasn't visionary investing. It was a cigar butt strategy, buying a dying business for less than its liquidation value, hoping for one last puff of profit. The business was hemorrhaging cash. Foreign competition was crushing the mills. It was commodity hell. No pricing power, no moat. But in 1965, Buffett took control. He realized the textile business was a dead end, but the corporate shell was a perfect vehicle. He stopped fighting economic gravity. Every dollar of profit the mills generated was diverted. He didn't reinvest in textiles. He reinvested in dominance. By 1985, the mills were closed. The textile company died, but the compounding machine was born. How do you build a machine that compounds at 20% for 60 years? The answer lies in 2 pillars: economic moats and structural float. Let's start with moats. Buffett developed an obsession with durable competitive advantages, not temporary edges, not market timing. Structural moats that protect a business from the laws of competition. He hunts for 4 specific types. First, brand power. Coca-Cola isn't just sugar water, it is a psychological moat. People pay a premium for the brand, and no competitor can replicate a century of cultural penetration. Second, network effects. American Express thrives because merchants accept it, because consumers use it. It is a self-reinforcing loop. Third, cost advantages. Jayco's direct-to-consumer model eliminated commissions. It created a structural cost advantage that competitors couldn't match without destroying their own business models. Fourth, high switching costs. When a business integrates a service deeply into its operations, leaving becomes too expensive. That creates pricing power. Moats create pricing power. Pricing power creates excess returns, and excess returns create free cash flow. But Buffett needed a way to accelerate that flow. He found it in insurance. This is the secret engine: insurance float. When you buy insurance, you pay premiums up front. The company pays claims much later. That gap is the float. Technically, it is a liability, but for Berkshire, it is cost-free capital. In 1970, Berkshire's float was $237 million. Today, over $160 billion. Imagine having $160 billion to deploy without paying interest. No debt covenants, no Wall Street demanding quarterly growth. This is the ultimate leverage. Buffett used this float to buy See's Candies, to accumulate Coca-Cola, to build massive stakes in Apple and American Express. If you earn 10% on $160 billion, of other people's money, you are making $16 billion in annual returns for free. It isn't magic. It is financial engineering. The Warren Buffett of today is not the man of 1965. Early Buffett bought cheap cigar butts. Late Buffett, influenced by Charlie Munger, pivoted to quality. Buy wonderful businesses at fair prices, not fair businesses at wonderful prices. This evolution reached its peak with Apple. Critics said he'd lost his mind. Buffett doesn't understand tech, they said. But they were wrong. Buffett didn't buy Apple as a tech company. He bought it as a consumer monopoly, a brand with a massive moat, an ecosystem with extreme switching costs. Starting in 2016, Berkshire built a position that grew to over $170 billion. Apple became the ultimate expression of his principles: extraordinary economics, predictable cash flows, and massive share buybacks. What is the final lesson? It is not about stock tips, it is about architecture. First, build around structural moats. Protect your returns from competition. Second, master capital allocation. Free cash flow is potential energy. Direct it where it clears the highest hurdle. Third, let compounding do the heavy lifting. The math of exponential growth is more powerful than human intuition. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." He didn't build his fortune by being smarter or working harder. He built it by being more disciplined. The $600 billion machine was built decision by decision. No shortcuts, no leverage. Capital allocation is everything. Moats matter. And compounding, given enough time, is the most powerful force in the universe. If you want institutional-grade analysis on capital allocation and the strategies that build real wealth, subscribe to the Market Intel Hub. We break down the financial architecture of the elite. Thanks for watching.